Right now, something is happening in the global financial system that most people are completely ignoring. My name is Zara, and in the next few minutes, I am going to tell you why silver is no longer just a metal. It is a financial alarm bell, and it is ringing loudly for those who know how to listen. A few years ago, I was reviewing commodity supply data late at night, and I noticed a pattern: demand climbing, supply flattening, a gap forming quietly underneath the surface. I had seen this pattern before in other markets, and the people who acted on it early did not get rich overnight. But they built something real, something lasting. The people who dismissed it lost nothing immediately, but they lost the opportunity forever. I do not want that to happen to you. Silver has been used for 6,000 years, but today it is not just jewelry or old coins. Silver is inside your solar panels, your electric vehicles, your smartphones, your medical equipment, and your 5G infrastructure. It is the best electrical conductor on the periodic table. No synthetic material has fully replaced it in industrial use. And because each product only uses a small amount of silver, manufacturers keep using it even as prices rise. They have no reason to stop. Meanwhile, new silver mines take 7 to 10 years to develop. Existing mines are producing lower quality ore, and a large portion of silver comes not from dedicated silver mines, but as a byproduct of copper and zinc mining. So supply cannot simply be turned on like a tap. The result is a widening gap between what the world needs and what the ground is providing. That gap is called a supply deficit, and history shows us clearly what happens when a supply deficit meets inelastic industrial demand. Price moves, not because of hype, because of reality. This is where our story begins. Most people imagine a price explosion as something loud, something sudden, breaking news, panic buying, headlines everywhere. But the truth is, the most powerful price moves in commodity markets begin in complete silence. They build slowly, invisibly, underneath the surface. And by the time the average person hears about it, the early movers have already positioned themselves. Let me explain exactly how this works with silver. For months, sometimes years, a supply deficit exists in the market, but prices do not immediately reflect it. Why? Because large institutions, governments, and industrial buyers have stockpiles, reserves they built up during times of surplus. These reserves act as a buffer. They absorb the shortage quietly. The public sees stable prices and assumes everything is fine. Nothing to worry about. Move along. But those stockpiles are not infinite. They deplete, slowly at first, then faster. And the moment a major buyer enters the market and cannot find enough supply at the current price, they offer more. Another buyer sees that and offers more again. And suddenly the price that was calm for 2 years moves 10% in 2 weeks, then 20% in a month. Then the news catches up. Then retail investors flood in, and the move that began silently becomes the headline everyone is chasing. By that point, the calm early investor is already sitting on significant gains, not because they predicted the exact moment, but because they understood the fundamental story and had the patience to wait for it to unfold. This is the financial lesson hidden inside every commodity cycle. Timing the exact top or bottom is impossible, but positioning yourself correctly before the crowd arrives is absolutely achievable. It requires knowledge, discipline, and time, nothing more. The common mistake most people make is waiting for confirmation. They want to see the price already moving before they act. But confirmation always comes with a cost. The cost is that you are now buying what smart money bought months ago at a much higher price with much less upside remaining. Understanding the shortage early is your confirmation. The data is your signal. The patience is your edge. Now I want to talk about the mistakes. Because understanding silver's opportunity means nothing if your behavior destroys the outcome. And in my experience watching people navigate commodity cycles, the mistakes are always the same. They repeat themselves like clockwork, and they are entirely avoidable if you know what to look for. The first mistake is panic buying. When silver starts making headlines, when prices jump and social media lights up, a certain type of investor loses all rational thinking. They see the number going up and feel an overwhelming fear of missing out. They buy large amounts at elevated prices with no plan, no strategy, and no understanding of what they actually own. Then, when the price pulls back, as it always does during any major move, they panic sell at a loss. They entered with emotion and exited with emotion. And they walked away convinced that silver was a scam. It was not a scam. Their behavior was simply incompatible with the asset. The second mistake is over-concentration. Some people hear a compelling story about silver and decide to put everything into it. Every saving, every rupee, one asset, one bet. This is not investing. This is gambling with a financial story attached to it. No single asset, no matter how strong its fundamentals, should consume your entire financial life. Silver should be one part of a thoughtful, diversified, long-term portfolio, not the whole portfolio. The third mistake is ignoring the form of ownership. There is a significant difference between owning physical silver, owning a silver ETF, owning shares in a silver mining company, and trading silver futures. Each carries different risks, different costs, different tax implications, and different behaviors during a price move. Many people buy what is easiest without understanding what they actually hold. And when the market moves in unexpected ways, they are caught completely off guard. The fourth and most dangerous mistake is short-term thinking applied to a long-term story. Silver's supply deficit will not resolve itself in 3 months. This is a multi-year structural shift. If you buy silver expecting to double your money by next quarter, you will likely sell too early, lose patience during a correction, or make emotional decisions that undermine a fundamentally sound position. Wealth is built by people who understand the story deeply enough to stay in it long enough for the story to finish. So now that you understand the opportunity and you understand the mistakes, let us talk about what a responsible, intelligent silver strategy actually looks like. Because knowledge without action is just entertainment. And I want this to be genuinely useful to your financial life. The first principle is position sizing. Ask yourself honestly, what percentage of your total savings and investments are you comfortable allocating to a commodity with real upside, but also real volatility? For most long-term investors, a range of 5 to 15% in precious metals, including silver, is considered a reasonable hedge and growth position. It is meaningful enough to matter if silver performs well, but it is not so large that a short-term price correction threatens your financial stability. The second principle is dollar cost averaging. Do not try to buy all your silver at once at what you believe is the perfect price. Nobody knows the perfect price. Instead, decide on a total amount you want to invest and spread your purchases over several months. Buy a portion this month, a portion next month, a portion the month after. This strategy removes the pressure of timing and smooths out your average purchase price over time. It is boring, it is unsexy, and it is one of the most effective strategies in long-term commodity investing. The third principle is choosing your form carefully. Physical silver in the form of coins or bars gives you direct ownership with no counterparty risk, but it requires secure storage. Silver ETFs give you easy market access and liquidity, but you do not own the physical metal. Silver mining stocks give you leveraged exposure to silver prices, but also carry company-specific risks like management decisions and operational costs. Each form has its place. Your choice should match your goals, your risk tolerance, and your overall financial situation. The fourth principle is patience as a strategy. Set a time horizon before you invest. Tell yourself clearly, I am holding this position for 3 years minimum. Write it down. And then do not check the price every day. Do not react to every news headline. Trust the fundamental story you did your research on and give it time to develop. Silver's story is not a sprint. It is a marathon. And the winners of marathons are not the fastest starters. They are the ones who paced themselves intelligently and never stopped moving forward. We have come to the final part of this conversation, and I want to end not with excitement, not with enthusiasm, but with something more valuable, a clear-eyed, honest warning. Because the greatest disservice I could do to you is send you away feeling pumped up and emotionally charged about silver without grounding you in the reality of what long-term investing actually demands. Here is the warning. Silver will not move in a straight line upward. There will be corrections. There will be months where the price drops and the news turns negative, and everyone around you says the opportunity is over. There will be moments where you question your own research, where you feel foolish for holding a position that the crowd has abandoned. Those moments are not signs that you were wrong. They are the price of admission for every meaningful long-term investment opportunity that has ever existed. The people who could not pay that price emotionally are the ones who sold at the bottom and watched the recovery happen without them. Here is the real danger. It is not silver. It is you. It is your impatience, your fear, your need to feel validated by short-term price movement. The market does not care about your feelings. It rewards the prepared and the patient. It punishes the emotional and the reactive. You get to choose which category you belong to. Now here's your takeaway. Carry it with you. Silver is experiencing a real, documented, structural supply shortage driven by accelerating industrial demand and constrained mining supply. This shortage has historically preceded significant price movements in commodity markets. The opportunity is real, but it rewards only those who approach it with discipline, diversification, a long time horizon, and complete emotional control. Do your own research. Speak to a qualified financial advisor before making any investment decision. Understand what you own before you own it. And never invest money you cannot afford to leave untouched for several years. The world is changing fast. The materials that power that change are becoming scarce. And the investors who understand scarcity before the crowd does have always been the ones who built lasting wealth, quietly, patiently, and without chasing headlines. My name is Zara. Thank you for staying with me through this entire conversation. This was not just a video about silver. It was a lesson about how real investors think, how they wait, how they protect themselves from their own worst instincts, and how they position themselves to benefit from the world as it is actually changing, not as the headlines describe it. The decision now belongs entirely to you. Make it wisely.